Hey guys, welcome back. Peter Lynch was one of the legendary investors of the 20th century. He is well known for being able to get a 29% average annual return as a hotshot fund manager at Fidelity. If you would have invested in Peter Lynch's fund, your money would have grown over 28 times. He outperformed over 99% of all the other fund managers out there, so clearly an excellent person to learn from. So in this video, we're going to be breaking down a very valuable interview he gave when, at the time, the stock market was setting all-time highs, very similar to today. In fact, check out this chart. So this is a long-term chart of the S&P 500 and it goes all the way back to 1928, and you can see here it goes through Second World War, and then we have this big run up to the dot-com crash. We have the next run up to the 2008 financial crisis, and then look at what has happened in the last 10 years. We've had this absolutely epic bull market run, the biggest one in history. And when we talk about stocks being at all-time highs, this is where we're at today. As always, if you do find anything useful in the video, don't be shy, be sure to drop a like. That would be much appreciated. Okay, sit back and relax guys. Here is some investing wisdom from legendary investor Peter Lynch. Okay, here is what we've got coming up. We're first going to hear him talk about stocks being at all-time highs and the problems that can cause. He then talks about how to invest in stocks, some tips and strategies. We'll then take a look at how to handle when a stock declines, and this could be a stock that you own or a stock that you have your eye on. And then we'll finish with his thoughts on short-term trading.
And I am very pleased to have him back at this table. Welcome back.
Hey, Charlie, good to see you.
It's smart of me to schedule you on a day like this. 3 months ago, I said, when do you want Lynch to come in? Right. I said, let's get him on Tuesday. Something's going to happen in the market that week, and so here we are.
Glad to be here.
Explain to me what's going on.
Well, we had a huge run. I mean, the market was 4,000 just 2.5 years ago,
yeah,
and it ran up to 8,300 in August. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow, and it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000, and that caused 7 years of inflated real estate, people overspending, and basically they've been in a recession for 5 or 6 years because their market went up too high. I mean, if the market goes up too high, I mean, if the market goes too high, you're discounting earnings 7, 8, 10 years out. There's a relationship.
So everything is overpriced.
Yeah, and that doesn't help anything. The market since World War II has sold between 10 times earnings and 20 times earnings. If you look at the Dow Jones or the S&P 500, if you add up all the companies and take the earnings, you say there's a relationship. And it follows. McDonald's earnings have been terrific the last 30 years, and the stock's been terrific. There's a direct relationship. So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range. There wasn't a lot of room left on the PE
of 20
side.
is at the top of how high it should ever be.
Right. It's been over there only a few times ever over 20, and that's when usually inflation's about zero. In the early 60s, when inflation was about zero, we got a little bit over 20. Now we have a very low inflation rate. So if you usually have subtracted inflation from 20, you've had the PE of the market. That's been a pretty good ratio. When inflation was 12%, you remember in the early 80s, we had an 8 or 9 PE of the market. I never thought I'd ever wish for the market to not go up dramatically, but let's argue the market went to 16,000 tomorrow.
Yeah.
Basically, there's earnings behind companies.
So the earnings he was referring to were actually PE ratios, P being the stock price and E being earnings or company profits. And he mentioned historically they typically fall in the range between 10 and 20. So this is a long-term chart of PE ratios, and it goes back all the way to 1880. And what Peter Lynch was saying is that it fluctuates between this 10 and 20 range. And what he was saying is that historically it's gone from this 10 to 20 range, making the average being about 17. And at the time of that interview, it had broken past 20. However, for everyone watching today, this is where we're at today, 35. And as you can see, this is now higher than the 1929 Great Recession. But it's not as high as the dot-com crisis just yet. And he said it's actually a bad thing if stock prices go up too fast too quickly. He said when this happened to Japan, this led to inflated real estate prices and also a recession that lasted years. Sound familiar? Okay, next up, he gives some advice for investing in stocks and how to do it properly. Let's take a look.
But you have to look at 20 to find one. It's just you don't go to the mall and find the stock. I mean, you have to say, my God, this sounds like it's good. And then you have to do some steps. You have to do an organized method. People are careful when they buy a toaster. They're careful when they buy a seat. They do some research.
But they don't do it with stock. They call up the broker or they see somebody at lunch and they say, man, I got this hot stock, and you run right out and you spend $5,000, small investors.
Yeah. Or even worse, they put an option in International Data WAC. They don't even own International Data WAC, so they have a 90-day play.
But Bill said it was good and they make a lot of money.
Right, and it's like a casino. You have to have an edge. I mean, let's say the cement industry goes from crummy to semi-crummy to fairly good. The stocks are going north. You're going to make money. That's the industry you know. What if you know the publishing industry? Some people have an edge. You work. I mean, what if you last 30 years you worked in the restaurant industry? You would have seen Taco Bell. You would have seen Sbarro's. You would have seen Pizza Hut. You would have seen Chili's. You would have seen these companies doing very well. You should have bought those instead of trying to buy biotechnology stocks you know nothing about. I mean, I know nothing about local area networking. A lot of people are buying this Cisco. They're buying the equipment, saying, we're going to route together all these peripherals and put together the servers.
Well, but that's not a bad buy because they own a huge percentage of their market.
You know, but they're saying only a few people had them. I said, my God, if it works for us, other people will try it, then colleges will try it, high schools will try it, then they'll go overseas. They knew they were early in the ball game.
Right.
And they should have been buying that company instead of out buying something they don't know anything about, some oil drilling company. I mean, people have this tendency to always buy something they don't. All you need is a few, Charlie, all you need is a few good stocks a decade.
But this is your song. This has been your song for a long time. Only buy what you know.
No, but people are waking up in the morning and say, there's 5,000 companies out there. Which one should I buy? The average person ought to be able to follow 4 or 5 companies. They ought to be able to lecture on them. They understand the companies. So you can say, this is a company I want to look at, and I want to see what do the cash looks like. And if you don't understand what cash is, if you don't understand what debt is, I always said, let's say you're looking at companies that are doing poorly. They're not doing very well. Why don't you buy the one that has $300 million in cash instead of the one that's almost bankrupt? I mean, a lot of companies are selling at $2 or $3 a share. They might be losing $10 million.
That's a no-brainer, isn't it?
But people don't do it. And
well, they don't do it because they don't know how to do the research.
Well, this you can look up the balance sheet. Say, listen, they got $300 million in cash. They're losing $10 million a quarter. They'll be okay. Yeah. This other company's got no cash, $700 million in debt. They're about to blow taps.
But you're telling every small investor in America anyway they ought to invest in a mutual fund, aren't you?
I'm telling you, you can do both. You could be investing in mutual funds, and occasionally you should be able to find a stock that's going to make a difference in your life.
If it's an industry you know something about.
Industry or a local company, if they're not ready to do it properly, they shouldn't do it. And it used to be able to retire, and you get half of your last year's salary. Yeah. You'd have a pension. You could rely on that. Now you have to do it for yourself. Some people are presented, they're let go, or they're early retirement, and they're given $500,000, and they say, this is it. This is your retirement, lady. You've got to take care of it now.
Such a great bit of advice. He said you have to look at 20 to maybe find one. And then it's all about having an organized method of research. I think one of the problems that many people fall into today is that they buy stocks like they're at a supermarket. So nowadays we have these nice fancy apps and it's like, yeah, I'll have one of those, I'll have one of those, give me some of this. You got that one? No, need, got, need. But the problem being is that we don't actually know anything about the companies we're actually buying. He then mentioned about finding your edge. So think about the specific industry that you work in right now. Are there any innovations or any companies coming through that most people don't know about yet? This might be something that you can capitalize on. And then one of the most important quotes in this whole piece, which you might have missed because it was very quick, which was this: all you need are a few good stocks a decade. And Warren Buffett actually says the same thing. All you need are a few good companies. But then you should know the key fundamentals on those companies. Things like, do they have a strong cash position? How much debt do they have? Can you see a clear competitive advantage? And he also mentioned about investing in mutual funds as well as a couple of good stocks. Okay, so next up, what happens when a stock drops? Now this could be some stocks that you own, or it could be some stocks that you have your eye on. Here's what he said.
Tell me what took place overnight between yesterday at the close of market and today at the beginning of market. What were the guys that you used to work with saying to each other at Fidelity, and what were the people you know saying? For example, IBM made a decision to buy back their stock, and that presented some kind of push on the market, and their stock went up 6 points.
Well, one thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. their earnings are doing well, their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and say, big deal. So you're trying to find companies you liked anyway. Right now you liked them, and now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise, and then had a very, a 5-for-4 sale.
If you had been managing the Magellan Fund this morning,
Yes.
you would have been buying like crazy?
I would have been researching like crazy. I would have been saying, which companies are the same story? Is there anything really happening? This is a non-event for them. They're still doing well. Even if we have a recession, there's nothing to do with them. And that's the kinds I would try to buy. But let's say if a company, just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say, it has to work. And then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't know.
Now, the key message for me is actually that the company and the company's stock price are actually two different things. A company's stock price could be falling even though the company's actually doing quite well. Conversely, a company's stock price could be soaring even though the company is actually struggling. So stock prices are constantly fluctuating to overvalued, to undervalued, to overvalued. And by knowing the key fundamentals of the company, you will know whether it's actually good value for money and worth buying. Make sense? Okay, next up, Peter Lynch's thoughts on short-term trading. Let's take a look.
So what you're saying to people today about the future of the market over the near term is what? What's your feeling?
We can take
I got to buy business.
We can take a coin out and flip it. I have no idea what the next 1,000 points is going to do. The next 6,000 points is going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know where the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes stocks
didn't
go up.
exist 20 years ago.
That's what makes Amgen has two $1 billion drugs. They didn't exist 20 years ago. New companies have come along. That's what makes this country work. You got to keep your eyes open.
All right. So you're optimistic about the future of the American economy. Earnings potential for most well-run companies will do all right.
But people have to understand we've had 9 recessions since World War II. We'll have other recessions.
But we're not in one now.
But we may have
goodness.
one in the future, and don't get worried about it. It will have one. Sometime it'll happen, and no one will tell you when it's going to happen. It's just,
Well, but won't the fundamentals tell you?
no, you'll find out after the fact. All of a sudden you'll notice orders slowing, prices get more competitive, then earnings are down. I mean, usually you find out after the fact. No one declares. Everybody's been saying we're going to have a recession for 5 years. It just hasn't happened.
It's great to see you. I hope
Okay,
you'll
Charlie.
come back anytime, Peter.
Excellent.
Thank you
Thanks,
very
Charlie.
much.
So, Peter Lynch has no idea where the next 1,000 points is going to be. It could be up, it could be down, we may as well flip a coin. But the next 10,000 points or 20,000 points are likely going to be up. Company profits 10 years from now will likely be doing better. And that is what we need to rely on. And again, this is actually very similar to what Warren Buffett says as well. The key message being you only ever need a few good stocks. Okay, so there you are guys. That was some investing wisdom from one of the legendary investors, Peter Lynch. And I hope you found this useful. In fact, just one favor to ask. If you did find anything useful in the video, then be sure to drop a like. It only takes 2 seconds and it really would be much appreciated. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching and I'll see you in the next video. Bye for now.